On December 21, 2020, Tesla entered the S&P 500. The company did not open a new factory that morning. Its cars did not suddenly become faster, but one line in an index rulebook changed, and that created a very real portfolio problem for every fund trying to track the benchmark. The timeline is unusually clean. S&P Dow Jones Indices announced Tesla's addition on November 16th. Because Tesla was so large, S&P even asked the market whether the stock should be added all at once or in two stages. It ultimately chose a single-step addition effective before the market opened on December 21st. Tesla replaced apartment investment and management in the S&P 500. Why did implementation matter so much? An index fund promises to deliver the return of an index, minus costs and tracking differences. When the index changes, the fund's target portfolio changes too. A fund that tracks the S&P 500 cannot simply say, "Tesla looks expensive, maybe we will wait a few months." To keep matching the benchmark, it must rebalance toward the new constituent and away from whatever leaves, using the index weight and implementation rules as its map. That does not mean every buyer waits until the final second. Traders know announced index changes are coming. Some investors buy ahead of the effective date because they expect demand from tracking funds. Active managers benchmarked to the index may adjust too. Other investors provide the shares. The result can be enormous trading volume around implementation, even though the company's underlying business did not change overnight. Tesla made the contradiction impossible to ignore. S&P estimated its float-adjusted market capitalization at roughly $304 billion when the addition was announced, making it the largest S&P 500 addition at the time. The index provider described the event as important enough to consult the market on how to execute it. That is market plumbing becoming a headline. But here is the part that gets lost in the forced buying story. Index inclusion is not a guaranteed stock price rocket. S&P's own research on additions and deletions from 1995 through 2021 found that the classic index effect had been declining over time, potentially helped by better liquidity. Academic work on Russell Index rebalancing has found evidence that inclusion can affect demand and trading, but that still does not prove a permanent price increase for every stock. So, who wins and who pays? There is no universal answer. Existing shareholders may benefit if anticipated index demand lifts the price. Traders who position correctly around the rebalance may profit. Tracking funds, meanwhile, have to manage implementation costs, market impact, and tracking error on behalf of their investors. The exact transfer is difficult to isolate because fundamentals, speculation, and index flows all overlap. The absurd part is also the useful lesson. At one moment, a company can be outside a benchmark. After the rule change becomes effective, trillions of benchmark-aware capital suddenly have a different instruction sheet. The business did not become more valuable because the clock changed. The ownership demand changed because the benchmark changed. The calm verdict: index inclusion can create mechanical buying pressure and extraordinary trading activity, but it is not a magic valuation wand. When a stock joins a major index, separate the flow story from the business story. One can change overnight, the other usually cannot.